Welcome to Primary Markets TV. I'm Dan Barnes. This is your weekly update on newly issued securities in Asia Pacific, Europe, Middle East and Africa, and the Americas. This week is seeing the launch of several initial public offerings on the Australian Stock Exchange, with IPOs from Universal Store Holdings and Native Mineral Resources Holdings listing on 16th, today Monday, Caspin Resources Limited and Metal Hawk listing on Thursday the 19th. Hong Kong Stock Exchange is seeing several more listings from Sichuan Tianzow Breeding Technology on 16th, Sunkwan Properties Group and Jinke Smart Services Group on Tuesday the 17th, and then Yadong Group Holdings and Shinsun Holdings on the 18th. Japan Exchange has one listing on the Tokyo Stock Exchange, payments and CRM technology provider Arara, out on the 19th. Singapore's most recent IPO was Nanofilm Technologies back on the October the 30th, which took SGX Technologies cluster to a total of 81 listings, with a combined market capitalization of more than $69 billion. In the fixed income markets, year to date, we've seen around 314 billion of corporate bonds issued in Asia Pacific and around 22.6 billion of rates issued in Asia Pacific, according to data from Morgan Stanley and Bond Radar. In China, analysts are reporting that corporate bond issuance picked up to 252 billion renminbi in October, potentially indicative of greater funding needs from corporates, likely related to continued catch-up on some infrastructure investments. In India, we have Muthoot mini financiers issuing bonds on the Bombay Stock Exchange coming up this week. Now, joining me today are John Fildes, lead for capital markets at Bain in Asia Pacific, Charles MacGregor, head of Asia at Lucror Analytics, based in Singapore. Lucror is an independent fixed income research house. Welcome to the show, guys.
Thanks, Dan.
Looking at the equity space, are there any particular trends that you've seen for IPOs in Asia Pacific year to date, and anything more recently?
The amazing thing about this year, given all of the turmoil that we've seen everywhere, is that the IPO market is actually being up in Asia Pacific.
Yeah.
When you look at the year-to-date to end of Q3, the China market was up about 30% year-to-date. Hong Kong has been up 57% year-to-date. Wow. And that's a phenomenal performance, when last year had some record listings with Alibaba in Hong Kong and Saudi Aramco in Saudi. So to see this increase in this year is really quite amazing.
Absolutely. Do you have a sense for what's driving that?
The Hong Kong and China drivers are slightly different from the rest of the world.
Sure.
I mean, Europe has seen a dearth of IPOs really this year. China and Hong Kong have led the world, followed by the Americas markets. Actually, Brazil's been performing very well. But what's really driven Hong Kong and China, in the case of Hong Kong, it's been, if you like, the returnees. It's been those China-based but US-listed entities that have chosen to do a secondary listing in Hong Kong now. So I'm thinking JD.com, NetEase, Yum China, and so on. That's been 102 billion Hong Kong dollars so far. And in China, I think the star market has really driven that. You know, the star market has been, 53% of the funds raised in Shanghai year to date. There's a pipeline looking forwards of over 200 listings queuing up on the star market. And that's all technology and industrial companies. So that's a phenomenal growth story.
In terms of sectoral trends, is that reflective of the sort of IPOs we've seen for the rest of the year?
Yeah, I mean, the star market has really been the driver, and that's very, very tech-driven, as is the Chinext market, which has also been the big driver of Shenzhen's IPO growth. So definitely technology, definitely China-focused. That's been a really big driver.
That's great. Thank you very much. Charles, can I come to you? Looking at the fixed income markets in Asia Pacific, are issuance volumes where perhaps you might expect them to be for this time of year? And how does that compare to previous years?
The issuance volumes are way in excess of what I might have expected this year, especially given that in March and April, there was very little issuance just because of the COVID basically shutting down China. Yeah. But since then, we've seen volumes pick up again. And as you said before, what we're sort of 320 billion year to date, and it's about 16% over last year. So, and last year was a record year, so huge. We think there are a number of reasons driving this. Yields in returns in Euro high yield, US high yield, US investment grade haven't been very strong. And especially at this time of year now, we feel that investors are concerned about the possibility of Treasury yields spiking.
That makes sense.
Due to a vaccine that's now looking as though it's going to be in the short term, not the long term, a relatively quick pace of economic recovery, and obviously the economic stimuluses that are expected to come through. So their concern now is, rather than looking for duration to enhance their returns, they're potentially going to be shifting to high yield to get that return.
Again, looking at sectoral trends, are there any in fixed income which you found particularly interesting or any worthy of note?
The predominant issuance continues to be from banks and property companies as far as China is concerned. We've seen an additional Tier 1 capital issue from Bank of Communications just 2 days ago, and that was $2.8 billion, and that was well received. At the same time, we saw the 20th largest property company, Genro, issue a green note. And it was only $200 million, but it was 11 times oversubscribed. So we're aware that ESG considerations are playing an increasingly major part in investors' considerations at the moment.
Are there any characteristics of bonds being issued at the moment which are of interest around covenants, things like that? Because we've seen a weakening of covenants, certainly in Europe and the US to some extent.
Covenants are probably more important from a high yield perspective because you don't get many in an investment grade one. To be frank, in Asia, covenants really aren't that critical because the legal systems have a lot of uncertainty about them, unlike Europe or the US, where you can go to a court with a reasonable idea of what the outcome might be. Yeah. What the covenants do is it helps us understand what management's objectives are and what their commitments might be. That said, we are seeing over time that they're becoming less onerous, if you like, on the companies, but they came from a relatively high base compared to the US. So I'd say if you're just looking at the covenants within themselves, they're probably still better than US high yield, but that's not saying a lot. But just remembering that investors really don't look that much at the covenants.
Sure.
It's more about really just looking at the risk of default.
You mentioned the level of oversubscription to one of the issues there. What's your sense of investor appetite across Asia Pacific right now in different geographies?
Well, the reality is that the majority of the bonds are staying in Asia, and I suspect that a lot of them are going to Chinese banks. That said, I think there is an increasing proportion that are being picked up by European. The US investors, less so because they tend to look more at the 144A issues, and the vast majority of issues out of Asia are Reg S issues. They don't go to the US on their roadshows. There is this sort of hunt for yield, if you like, and Asia is attractive in that regard. Default rates have ticked up a bit in China, but these are predominantly companies that should never have been allowed to enter the US dollar bond market. They're kind of pseudo-government related, but not really an SOE, and weak business models. If you put those aside, I think there's still a strong appetite for Asian credit.
It's really interesting what's happened in the high yield market in that, if you take, for example, Country Garden's 2030 bond, before the crisis, it was trading about 101. When COVID hit, it dropped to about 90, but it's actually now rebounded to about 104, 105. So it shows there's even a higher appetite for Chinese US dollar denominated high yield offshore bonds than there ever was. And I think that's growing.
Guys, thank you very much.
Thank you, Dan.
Thank you. It's a pleasure.
We've seen several firms announce their intention to float on the London Stock Exchange, including newly established reinsurance underwriter Conduit, the Ecofin US Renewables Infrastructure Trust, Downing Renewables and Infrastructure Trust, and a closed-ended investment company, BH Global Sustainable Energy Opportunities. Later this month on AIM, we're also expecting, that's the small stock market, we're expecting the launch of Kostyál, a newly incorporated closed-ended investment company also focused on the energy sector. Activity on the LSE over the past week has included an IPO from Roundhill Music Royalty Fund, which began trading on Friday. And there's been a lot of bond issuance reported to the LSE, notably Chinese issuers being supported by HSBC, who have been coming to the market with debt that's often been of quite a short tenor, typically 1 year to maturity. Year to date, Euronext has seen 12 new listings across its markets, but done recently, while Deutsche Börse has also had a quiet period, with its last listings being retailer Fashionet and industrial equipment provider Complio Charging Solutions, both in October. A notable recent issuance was the new NL £500 million SDG bond, which is due on October 2027. That issuance has followed 2 SDG bonds issued by NL in euros and dollars last year. That new issue is notable because the European Central Bank has decided bonds with coupon structures that are linked to certain sustainability performance targets will become eligible as collateral for ecosystem credit operations and also for Eurosystem outright purchases, monetary policy purchases from the 1st of January 2021, provided they comply with all the right criteria. In Vienna, Wiener Börse has also had a quiet second half of the year with nothing new since August. Spain, BME, has continued to champion bond issuance with its fixed income market, MARF, which on Friday welcomed a new €100 million bond programme from Técnicas Reunidas to trading. We also saw the issuance of the Lucror S&P Global Developed Paris Aligned Climate Exchange Traded Fund on Nasdaq Nordics on the 5th of November. And we're going to hear more from Nasdaq now. So I'm joined by Adam Kostyál, who's Senior Vice President of Listing Services for Europe at Nasdaq Nordics, and Sean George, Chief Investment Officer for hedge fund StrukturInvest. Guys, welcome to the show.
Thank you very much.
Thanks for having me.
In the equity space, are there any sectoral trends you're observing around new equity issuance, and are volumes and activity where you might expect them to be for this time of year?
Put it this way, in March, I was not expecting to be where we are right now. I thought that was the end of the world. But in reality, I think there are 2 things that stand out for the Nordic markets, especially the Stockholm market, is A, we're able to list SMEs, which is something that Europe is struggling with because there's not the depth of the institutional investor base wanting to put in smaller tickets. And I think that's fundamentally a key issue in Europe. If you look at the Stockholm market, 80% of the households own shares. So you fundamentally have an active equity market from the core in terms of understanding wanting to participate in equity. Therefore, we have this from the ground up ecosystem to support small and mid-sized companies that want to access the exchange. That's why we're close to 60 listings so far this year. And then if you look at the sectors that are coming to market, I think what really stands out is that all these trends that we were talking about for many years, when are they going to come, when they're going to stand out, when are they going to establish themselves, have now proven to be key for society to function overall. I mean, in terms of the digital footprints, if you look at companies such as Zoom, you look at companies, in communication, how do you engage business-wise from a digital perspective? And I think that digital footprint is now no longer a nice to have, it's a must have. And I think from a retail or from an institutional investor base, there is a great appetite to participate in that from an equity perspective. So those are some of the key trends that stand out. Overall, the equity market has been very strong and continues to be strong, especially in this low interest rate environment. So everybody's looking for a return, and therefore all sectors are in a way benefiting from a very active equity market. However, some sectors need to show that they have returned from the corona slump and maybe need 1 or 2 quarters to show that really this has recovered before they can go out to market.
And Sean, on the fixed income side, are issuance levels where you might expect them to be? And have you seen any particular trends around bond issuance?
I think the main themes would be that, one, we've had a record year for bond issuance. And the main themes that characterized this year was a lot of issuance was pulled forward. People issued when the window was open for obvious reasons. You weren't sure what the trajectory of the virus was. And therefore, a lot of issuance and some of the issuance for next year even was pulled forward during the summer and early fall. And then you saw a second round of pulling forward prior to the U.S. elections. You had many issuers saying, this exact scenario that we're seeing today in the market, where you have an undecided U.S. election, we had agreed that this was really bad for markets, and the markets have done nothing but rally, mostly because people like myself had hedges on. The ECB is more involved in the European credit market than the Fed is in the U.S. credit market. That dynamic is expected to be even more so pronounced in the December meeting. I think the comment from Lagarde yesterday was the ultimate bazooka. So she's really setting the bar pretty high for herself. She's going to have to come out, Draghi times 2 to satisfy the market, but that's a problem for December. So the dynamics are, the book coverages are good. Only one thing that I would note on Thursday of last week, we participated in a bellwether U.S. company, one of our favorite credits. And I like to think we're a good client, but we got 100% allocation last week. When we're getting 100% allocations, maybe the U.S. market is a little more tired than the European market. Towards the end of last week, also you saw UPM came with a green bond. So the average books have been roughly 3 times covered here in Europe, Dan. UPM paper, cyclical company, came with a green bond, double the coverage, so roughly 6 times covered. But one thing that I'd like to point out, as we are an ESG fund, we also focus on social and a lot of other things, but we obviously buy green bonds. What we do and what we do differently is we hedge at that interest rate risk. That UPM bond, it's a BBB bond, paper sector cyclical, came with a coupon of 12.5 basis points, 2028 bond. So while we are doing good with these green bonds, and it's very important that we focus on social, vaccine or whatever the bond may be helping in our societies today, the investor base needs to be cognizant of the interest rate risk that they're taking on in these portfolios. I believe, one of the big trends this year is roughly 17 trillion worth of debt is yielding negatively. If we were to get inflation on the heels of a pandemic expansion, which I think a lot of people agree is coming some point next year with the virus information we got last week. It's increasingly looking that we could see an uptick in inflation, and an uptick in inflation could be the first shot across the bow for higher rates. And so that's the dynamic that we see, the cautionary tale, although we're very positive on the macro environment.
And Adam, do you expect ESG to be one of the primary drivers of new issuance in the first quarter, perhaps, of next year?
If a company does not have a clear ESG story, they're missing out. And what we're seeing now is the issuance of green shares on our exchange. So we're rolling out a program to support that. You see clean tech companies being much more in the focus, in the innovation that's coming from clean tech is clearly a center of appetite for institutional investors to be a part of. Yeah. Whether you are a listed company, whether you are aiming to list, you need to have a good ESG story. You need to be telling it well, because the appetite is there, and more of the institutional money is heading in that direction, especially passive. So from that perspective, and he's also within retail, that is much more awareness around that being a driver of investment.
Absolutely. Guys, that's been fantastic. Thanks so much for your time.
Thank you. All the best.
Coming up this week on the New York Stock Exchange, we're expecting initial public offerings from Aspire Real Estate Investors on Tuesday the 17th, with Telos Corporation and Sotera Health expected to list on Nasdaq this Thursday the 19th. If we look back at the biggest IPOs on NYSE over the past 30 days, and Nasdaq I should say, they've largely been in the healthcare and technology sectors, which is perhaps not surprising given the continual global grip that COVID-19 has on markets. And of course, we saw security firm McAfee return to the public sector with a $730 million IPO on the 21st of October. In fixed income, we've seen $4 trillion of US Treasury issuance in 2020 to date, according to analysts. And we've seen a good supply of new investment-grade bond issuance in Q3, following a very strong first half of the year. By October, we were up to a gross issuance of around $1.73 trillion, which Morgan Stanley's analysts put at about 65% up year on year. It should be noted that a lot of that cash will be sitting on balance sheets as a buffer, liquidity, of course, for those firms, rather than being spent. And refinancing, of course, is also thought to still be a big driver of supply. Joining me now is Simon Maughan, Liquidnet's head of trading alpha, and Paul Faust, head of strategy and product development at BondCliQ. And we're going to talk through some of the trends that we're seeing in primary markets. Guys, welcome to the show.
Hello. Thanks, Tim.
Simon, if we can start with you in the equity space, is the level of activity that we're seeing at the moment commensurate with what you'd expect at this time of year and relative to previous months?
As of November the 13th, we've had 370 IPOs year to date in US markets. That's 74% up on this time last year. And we are on track to be the strongest year since 2000 and, subject to what happens in the rest of the year, potentially beat that record. So that's good and bad. Everybody remembers 2000 as the peak of the tech boom. And I don't think too many people are hoping that we repeat that. But there are definitely some echoes given what's going on in markets right now.
That's very interesting. And Paul, just a sort of volume and activity perspective, are things around about where you'd expect them to be, or higher or lower?
Going into November is always a bit of a slowdown into the Thanksgiving holidays, and it's somewhat front-loaded in the beginning of the month. But we're running at, expecting about 70 billion worth of issuance in November in investment grade. That's probably about 50% of the run rate we've had this year, but 70 billion has been a good month historically. Typically, getting anything over 100 billion in any one given month is a big month for the U.S. markets. And when you factor in high yield, we've been at a run rate of about 200 billion a month, excluding March, obviously. We've actually pushed the overall corporate index out by almost a year because our average issuance is now 14 years versus an average of 10 years. There's definitely some composition pieces to it as well. With respect to, in this last couple of weeks, we've seen far more triple B issuance, and we've seen a bit more of an increase in financials than we typically have.
And Simon, just coming back on that point about which sectors are actually issuing, I mentioned tech and healthcare over the last week. What's your perspective on any sectoral trends we've seen in equities?
Yes, for sure. It's tech and biotech that have dominated and continue to be a feature of the upcoming pipeline. And there's a couple of reasons for that. The first in the tech space, we've seen great advances in recent years in modular technology and the rise of single issue companies that leverage cloud computing and can pull together packages and software very, very rapidly. And these are forming part of the new economy. And they're in a hurry to get to market because they can build these businesses quickly. So why not? In the biotech space, similar type of themes around the capacity of cloud computing. But if we think about all the advantages in gene and DNA technology and the advent of AI and pattern recognition, there's an awful lot of developments that have accelerated because of the advances in AI. And in cloud computing, and those type of names are looking to come to the market. But I would be remiss if I didn't mention the big trend of the second half of the year, which of course is the SPAC, the special acquisition company. And these are coming at a tremendous pace. And if we do breach that record 2000 issuance that I talked about earlier, then it will largely be because of all these SPACs lining up to get involved in who knows what, but most likely the tech and the biotech space.
Absolutely. And, I think it would be very hard for any investors to have missed the SPAC trend. But could you just give us a slight overview of what a SPAC is and therefore why it does have that sort of open-ended nature to it?
The basic problem that SPACs are solving is that the IPO market is bust. In the late 2020, if you have to pay 7, 8, 9% in fees to list on the equity markets, against a backdrop where we have about half as many listed companies as we did at the peak, something has to give, otherwise the equity markets are going to shrink away to nothing. And the SPAC is one solution to that. We've seen other companies try things like direct listings, but the SPAC is an alternative means of companies listing, whereby a fund with deep pockets or investors with deep pockets will list a vehicle that doesn't have any specific business purpose other than to make an acquisition. And investors invest into that stock, basically trusting the track record of the sponsor of that acquisition company. And those track records can be very varied. And typically, you will back an investor when they are standing by to put more of their own money into the investment, so that you know that you will be investing alongside them and they will be fully committed. But that's not always the case. So it's definitely buyer beware when it comes to the SPAC space.
No, very much so. And Paul, obviously, we've seen issuers sort of perhaps struggle then in the equity markets, as we've just discussed. But in fixed income, it's an issuer's market, right?
It's hard to believe when you've got a sub 1% treasury note that there is this type of demand. But until the end of October, we had 30 straight weeks of inflows into the market. So that's basically post-COVID. There's a lot of reasons behind it. There's been some rotation, obviously, with the equity market as high as it's gotten. There's a natural movement or demand to rebalance portfolios, and people have to add to fixed income on the other side. But as well, you've got the Fed in the backdrop. That's a big piece of this. And, when you're looking at sub 3% money, it's a good time for corporations to shore up their balance sheets. We did see, in addition to the issuance, you've actually seen a number of corporations actually buying back a lot of their shorter term debt as well. So they have been doing a lot of work in terms of adjusting their balance sheet and their liability makeup. So that's been a big piece of it. You had Verizon and Bristol Myers came this week, two very large tranches. I mean, the Verizon deal was, I think, top 10 in terms of size for the year. They're a little bit weaker with the market being a little bit weaker. But you had very small concessions. I think concessions are down to single digits for, a multi-tranche, $12 billion deal in Verizon's case. So, to your point, it's, full steam ahead, which is why we're seeing, a 60% increase on an already fairly active year of 2019.
Do both of you think that investor appetite is likely to be sustained? I mean, in fixed income, obviously, primary markets are a great source of liquidity. These are not perpetual instruments. One does have to constantly find new bonds to fit into the portfolio that fit the right criteria. So, Paul, I would guess that means that there's still that appetite there despite the very low rates.
Without question, it's continued, and it's actually seen a lot of retail money has come into the market. The muni market had its biggest issuance in October, and you've seen muni yields as a percentage of treasury yields are now back below 100%. So that's a fairly healthy sign for that market as well. Hard to say what gets in the way of it, but I don't think anyone sees rates going much higher in the next year. So in that kind of a backdrop, it actually makes credit look somewhat cheap here.
Paul raised an excellent point there about the strength of these markets relative to each other. As we get a lot of equity issuance, then you want your 60-40 portfolio or whatever it is it has to rebalance back towards fixed income. And then we get a lot of fixed income issuance, and that's doing two things. It's driving stock prices up when there's no issuance, but it's also creating the demand for this new issuance.
Absolutely. Guys, that's been great. Thank you so much.
Great. Thanks a lot.
Pleasure.